Hey everyone, it's Ed Kime, CEO over at Quantcha, and welcome to our November 22nd, 2015 news and updates video. In this video, we're going to take a look at our new Quandl database that's available over at quandl.com. It's our Quantcha Options Analytics database. It includes three major components that we use within our platform as well as in our UI. Those are put call ratios by both volume and open interest, as well as forward prices. And finally, we include our option break-evens, which are broken down by puts, calls, and of course the combined puts and calls for the all break-even. Like our volatility database, we cover virtually all US equities that have options. In this particular case, for the option analytics, it's over 4,000 stocks that we're currently updating daily. We also have history that goes back to 2002, which provides you a really rich set of data to work against in order to look at whether it's for machine learning or just eyeballing charts and laying over other data. And our future terms range from 10 to 100 to 1020 calendar days, so you'd be able to break down things that are going on over the next month, over the next quarter, over the next half year to full year, and of course 2 and 3 years down the road. And again, these are all based on the current data, such as the current quotes, the fundamentals, and the options for any given stock that is in our universe. Now, let's take a look at some of the places where you might use this. These are just examples to give you a feel for what's available within the data. Let's take a look at a put call ratio for the recent Microsoft earnings call that happened. And so we've got a chart here, and there's a few things that we'll take a look at. The first one is you'll notice that the timing here is over the October timeframe. This is a chart that was pulled down from Quandl.com, but of course you can go ahead and you can pull that data into virtually any platform you have or any tool you have to use, whether it's Excel or if it's more of the advanced machine learning software that's out there. Now I've marked off the earnings here, which was on October 22nd. And there's a couple things you'll note. The first one is we've got this orange line that goes through and shows the end of day overall put call ratio by volume for Microsoft. This was all the puts and all the calls that were transacted that day, with the puts divided into the calls. And you can see that it was at a peak, in the beginning of October, and it hit a low right there in the middle of October, around October 16th. And it's really kind of all over the place. I mean, one day it'll be at 0.3, the next day it'll be at 0.7. So that's kind of a wild thing. And there's a lot of stuff that goes into put call ratios by volume. And it is useful to see, and it's important to understand the impact of those put call ratios on the behavior of the stock, especially based on the various nature of the investors working with their money within that name. But another side of it is to take a look at the open interest, the put call ratios that are broken down by the end of day contracts that are held. So these are the number of puts that were held when the market closed, as well as the number of calls that were held when the market was closed. Now, by taking a look at the put call ratio that we have here by open interest, you can see that it's a lot more steady because there isn't that much drastic change on a daily basis. And you'll see that it started off high at around a 0.8, which typically is indicative of about neutral view on the stock. And by the time earnings came around, it was down to about 0.63, meaning that there were 63 puts that were held for every 100 calls that were held. And the open interest is kind of an interesting way to look at the put call ratio, because if you're holding your options at the end of the day, it means that you're looking at them as an investment more than just a quick day trade. And so having those available mean that you think that you can profit better by holding on to them for a little longer than it would be if you just were to divest of them as quickly as you could based on the current pricing. So we can see that as you got towards earnings, there was that trend downward towards a more bullish number for the open interest, while the volume was a little bit more wild. Now, if we break down the open interest put call ratio a bit more, we can see here that the pink line represents the 10-day put call by open interest, whereas the blue one is the 360-day put call by open interest. And you'll see that leading into earnings, there was a significantly fewer puts that were being held, and people were really divesting of puts as they were getting towards towards earnings. Either that, they were closing out their puts, or they were loading up on calls. And so you can see that that could be something you might read into for that week leading into the earnings. Whereas the behavior was a lot more conservative on the side of the 1 year out puts and calls. So that's where people were around a 0.8 and then went down to about a 0.7 after earnings. You can see really the next day was when that move happened. And so you can read into those a bit, especially if you start to get to know how these things trade over a long period of time. Now, taking a look at forward pricing, there was an interesting period last year when GoPro was hard to borrow over, kind of in that August to November time frame. Now, of course, GoPro's had a lot of short pressure over its life in various places, especially where options are concerned. Being able to pull that out is not always as easy to either identify it ahead of time or to be able to recognize the opportunities from within it. So a good example here is you can see that there's the 10-day forward pricing and there's a 360-day forward pricing. Now, generally, the forward pricing is going to be pretty close to one another. Sometimes when there's dividends involved, that will be factored in, of course, and the forward pricing for future dates will be lower. But what we can see here is that the forward pricing for that GoPro synthetic long, which is really saying, the forward price is the sale of a put and the purchase of a call at the same price, typically at the money, in order to replicate a long position in stock. So the break even for that is what we call the R forward pricing. And so if you have a stock where you're able to get a premium by selling the put versus the price of the call, that puts you in a position where it means that the stock is under a lot of pressure to move downward because people are trying to sell calls and they're trying to buy puts, and therefore it's driving put prices up and call prices down. Now you can see here the 10-day forward pricing is higher than the 360-day forward pricing, and that gap was fairly significant, especially as it kind of diverged as you got into October, and then it came back together again towards the end of November. And that was because people were more willing to get into those synthetic long positions over a 10-day period, or at least to sell out of them, I should say. Whereas over the 360-day period, people were much more reluctant to be able to sell puts or to buy calls because they felt that there was, I guess, there was a lot of downward pressure and the stock was more likely to fall down. And so we do see over time that the stock did go down. And actually, just to bring this back into focus, I should have mentioned this is the 2014 chart. This is not for 2015. So it was August to November 2014 when there was a significant amount of GoPro hard to borrow and short pressure. Now, taking a look at option break-evens, there's a lot you can read into option break-evens, and they apply some interesting pressure under certain circumstances. It's really more a measurement of what the market is thinking, especially around what market makers are willing to buy or sell, or the premiums they demand for options based on their expectations for the stock. And those premiums are often driven by the demand from people. So when the investors are very bullish about a stock, they want to buy the calls, which could push the prices up. So we've got there are three key things to look at here. This is a period of time around this SolarCity's earnings very recently, and you can see that on the day of earnings they closed at around $38 a share, and that was on the 29th of October. Now, there's a couple things here. The first one is you can see the call break even was much further away from the closing price than the put break even was. That means that the sentiment indicated that there was a lot of expectation for the stock to go up, most likely, or that the people who were buying into the calls were opening those call positions that were far out of the money. Either of those things can impact the distance between the closing price and the call break even over that 10-day horizon. At the same time, the put break-even was much closer to the price of the stock at the time, and you can see that the all break-even, which adds up all the puts and the calls, was a little bit higher than the closing price, but it was actually still closer to the put break-even than it was to the call break-even, which is indicative that there were a significantly higher volume of puts that were available that were being held in the open interest versus the calls that were being held. And so from this one chart, you can kind of see a few different things and understand the nature of what people are expecting. In this case, there was a huge volume of puts, but there was still a market for them that was relatively close to the price of the stock, whereas for the calls, there was a much lower volume, most likely that was significantly further out of the money, or at least expecting a bigger upside and a smaller downside for the stock. Now, if we dug in and took a look at the 360-day break-evens with the put, all, and call break-evens respectively, you'll notice that the distance is a little bit different now because the close for this the close is still obviously that same $38 mark, but the distance between the all break even and the calls versus the puts is a little bit more centered now. So you can see that there's a little bit more expectation that the stock over the long run would likely or at least the pressure between the calls and the puts is a little more even here, as opposed to the short-term 10-day one that was driven heavily by earnings. And again, there's a lot of ways to read into these charts and a lot of things that you could do for trading these. It turned out that SolarCity actually went down significantly after earnings due to missing. And so you can see that for the day after on the 10-day that the value of the all break-evens almost converged with the put break-even, which indicates that it was a significant movement in favor of the bearish side of the stock at that time. At the same time, you don't see that same drastic behavior in the 360-day because obviously those people are looking much further out. So again, thanks for taking a look at our new database out on Quandl. And if you've got any questions, please hit us up at hello@quantcha.com or go ahead and leave us a comment down here in the comment section.